Brilliant. Well, thank you very much indeed, Brian, first off, and good evening, everybody. My name is James Harries. I'm the manager of the Trojan Global Income Strategy. I hope this evening that I'll be able to help you with your decision for your ISA for this year, and particularly in a world, as Ryan said, that's pretty confusing at the moment. For those of you who have irreplaceable capital but are still in need of income, and I hope that we'll be able to provide you with some answers to how you might be able to go about doing that. At Troy Asset Management, we were established in the year 2000 by Lord Weinstock, which we're showing on the left here, and Sebastian Lan. It was with a specific or explicit aim of growing capital, but also preserving capital, and in this case, also generating an income. And that has a number of implications. It means that, generally speaking, we are very cognizant of the downside or the risks to any investment. We don't think about benchmarks at all. We get away from benchmarks, and we try and focus on quality, resilient businesses that we think can generate the returns that our clients require. We're called Troy because Lord Weinstock had a Derby winner called Troy in 1979. It's a pretty remarkable run. And we're able to offer this strategy in two different forms, if you like. Ryan spoke about open-ended and closed-ended strategies. We have an open-ended strategy, the Trojan Global Income Fund. We also have an investment trust called the Securities Trust of Scotland. We try and keep the investment process as Troy as simple and intuitive as possible. And what I mean by that is we try and invest in a concentrated portfolio of exceptional, resilient companies. And having invested in such a portfolio, we try and leave it to compound for as long as possible. And we do that by having very low turnover. We have about 10%. So we hold companies, generally speaking, for about 10 years. Well, if you hold a company for about 10 years, that means you need to be very certain about it before you invest clients' capital in it in the first place. So we want businesses that have high returns on capital employed, that have very predictable and understandable business models, and ones that we can hold for long periods of time and say something sensible about what those businesses might look like 5, 7, 10 years hence. We have an explicit aim to produce above average returns, but with below average volatility. Volatility matters, not because we equate volatility with risk. We think about risk in terms of permanent capital loss, and of course, Russia's reminded us that that can happen. But we do think volatility matters because if you've got a very long time horizon, volatility is kind of your friend because it gives you an opportunity to buy assets cheaply, and you can then ride them for long periods of time. If you have a slightly shorter time period, and often that coincides with retirement, then volatility is your enemy, because if you have a steep drawdown, you simply don't have enough time to recover that capital. So we think you're in a better position to be able to compound capital in that scenario if you avoid steep drawdowns, and our process is designed to do that. And finally, we want to be investing in businesses that generate enough cash to pay their dividends, as well as invest in the business to entrench their competitive advantages, which allow them to have high returns on capital, and also to be well financed, to have sound balance sheets. And we do that by investing in businesses that are highly cash generative, that are capital light, and that we deem to be high quality. Now, nothing I've said to you is particularly complicated. There are actually very few funds or strategies in the industry that are invested on this basis. We think carefully about what sorts of businesses we want to invest in, and we restrict ourselves to particular sectors and particular businesses. And you can see here that we, as I mentioned, avoid both capital intensity and cyclicality, and we concentrate therefore on sectors such as consumer goods, healthcare, business software, particularly business software as opposed to consumer software. And we avoid large parts of the market which are either being disrupted by technology or are low quality in our view in terms of capital intensity and cyclicality. So that's relevant today for a couple of reasons. First of all, because of the awful events that are taking place in Russia, and because of the bounce in commodity prices or the rise of commodity prices that we've had, we accept that companies such as mining companies and energy companies, in the short term at least, have better prospects, including and also aerospace and defense. To our mind, they're still low quality businesses. They don't have high returns on capital employed. They are cyclical. They are capital intensive. And over the long term, we think we should still avoid them. Similarly, businesses like retail and like telecoms, traditionally you would have invested in those areas for income, but we think now are so disrupted by the effect of technology that they should be excluded. So we don't own the very highly rated, expensive companies that have recently had a more difficult time. but we also don't consciously own those businesses that we think are being disruptive. We're trying to steer a middle course. I said the portfolios are generally concentrated, so we have about 34 companies in our portfolio, and I mentioned that we have about 10% turnover. So we have 2 or 3 new ideas a year, and that's the sort of cadence of activity in the portfolio that one should expect. But we're still doing a lot of work in the background on new ideas to ensure that there's a long list of companies we could buy. And we put at the top of the slide 3 that are excellent businesses that we like very much, that we'd like to invest in, but have been too expensive. What's interesting to me actually is all 3 of these are actually down nearly over somewhere between 30 and 35%. And so we are beginning to get to a point where some of these world-class businesses, which have historically been very expensive, are now able to be put into the portfolio. We're constantly trying to balance quality, income, and growth. And if we can upgrade either the quality or the growth of the portfolio without diminishing the income, then we'll do that. But you tend only to be able to do that at times of market stress, and it would appear that we are either in one or we're about to have one. So we have plenty of ideas, and we're ready to act should opportunities present themselves. We have put some newer ideas in the portfolio recently. So we bought Nintendo, probably a business that's familiar to many of you or many of your children. I remember playing Nintendo when I was young. I look at my son playing Nintendo. It seems to be completely evergreen intellectual property. We think that it's an inexpensively valued business. We think people are mistaken for the fact that the current console, which is called the Switch, is now actually much more of a software platform with 100 million user base. They're also moving into films and to theme parks, and we generally think that they're monetizing their IP in a way that they haven't in the past. CME Group is the Chicago Mercantile Exchange, it's a monopoly provider of futures and options, and as people have to hedge interest rate risk and inflation risk and commodity risk, they're perfectly positioned. And Fastenal is one of those brilliant but very boring businesses that we love. It delivers nuts and bolts, literally. They call them fasteners in the States. But each of these businesses, to us, are leaders in their industry, really high quality, entrenched competitive positions, high returns on capital, and a lovely balance between income, quality, and growth. There's many ways of demonstrating what a portfolio looks like. You can do it by geography, you can do it by sector, but here we're showing you what our portfolio looks like in terms of business model. And we're breaking it down to 4 key areas. The first is repeat purchase consumer goods. We think these branded consumer goods remain very powerful businesses. There are those that say brands are less valuable than they were. Well, perhaps, but they've been writing them off for decades. We also observed that there were those who said that in an online world, brands have become less entrenched. But I'm reminded my colleague Tomasz Boniek, who I work with, says that the biggest graveyard in the world is the second page of a Google search or the second page of an Amazon search. And we all have limited bandwidth, and we're still drawn very much to brands which deliver products and services which we like and enjoy. And we think these businesses have suffered weathered years and years of inflation, deflation, war, strife, and they still remain excellent businesses, and they make up a reasonable portion of the portfolio. The second is the top right platforms. Chicago Mercantile Exchange, Nintendo, and Intercontinental Hotels Group are all very different businesses, but they're all really at base software platforms, and they therefore have the sorts of attributes that we like. Not capitally intensive, predictable, entrenched positions, monopolies in many cases, and we think will be winners and resilient free cash flow generators for years to come. Bottom left, enterprise digital spend. I mentioned that we like enterprise IT companies as opposed to consumer companies. We think some of the consumer companies at least got a bit of a bump in COVID, but that's now normalizing. Whereas we think IT spent by companies is going to be more resilient. Every company in the world is putting their IT into the cloud, and some of our businesses are helping them do that. Microsoft provides the cloud, Accenture provides the expertise. Paychex and ADP are outsourced HR businesses. These are businesses that the impetus to outsource HR gets ever greater as HR becomes more complicated, and these are just lovely businesses. Big fragmented market, long runway for growth, because a software business have limited capital needs. Perfect example of the sort of business which balances quality, income, growth, what we're looking for. And finally, we grouped together a group of businesses that we call Dependable Income. Actually, this is underclubbing it slightly because these are excellent world-class businesses. McDonald's will be very familiar to you. Medtronic and Roche are both healthcare businesses. And the Link is the biggest and best managed, in our view, REIT in Asia. We have a global portfolio. We're looking at this on an underlying revenue basis. We think that giving yourself a global scope is a sensible thing to do. We wouldn't wish to restrict ourselves to any one single market, and this gives us the opportunity to invest in the best income businesses in the world. We have a large proportion in the North American market. That's conscious. We find the best businesses and we find it to be the best economy, but we also have about 25% in Asia and emerging markets. But I should say in developed market listed businesses. Our performance over time is slightly better than our peers, but with lower volatility. And I mentioned volatility is important to us. We have been left behind somewhat in recent times by the broader index as the very large technology companies that did very well. But you can see just by looking at this chart that in more recent times, the market's become a bit more tough. We've actually made up a lot of ground. And we could talk about what's going to happen in the future. Nobody knows. But we do face a world, I think, where we have an unusual combination of pretty elevated markets and rather an uncertain outlook. This is showing that in the same way. This is the long-term track record for the open-ended strategy, and you can see that we've done rather better than our peers with rather lower volatility. In fact, we're close to, if not the lowest volatility fund in the sector, and that's what you should expect if you were to invest in this fund. You can also see that in times of trouble, we do rather better than most. And this harks back to this point about low volatility. It's pretty remarkable to me that when we launched the strategy here at Troy in 2016, there's only been two, and I suspect the one we're having at the moment will be a third, but two drawdowns of more than 10%. I grant you one of those was quite short and quite sharp, that being COVID. But in both occasions, we were able to upgrade the quality and the growth of the portfolio, and we were able to outperform our peers, demonstrating that this is a fund for those who have a somewhat cautious mindset and wish to protect their capital and then grow it in that order. Overall, the portfolio is trading on about a 5.2% free cash flow yield. That's a measure of value, which shows that the value is somewhat better than the broader market, and we think pretty good value in absolute terms. And we think that free cash flow yield will grow pretty consistently at about sort of mid single digits. So overall, the 5.2% free cash flow yield growing at 5%-ish should give you a forward expected return, not guaranteed, not every year, not in a straight line, of about 9, 10, 11%. And if you look at my personal 15-year track record, that's pretty much what I've delivered over the 15 years. 3% in terms of income broadly, and 6% in terms of capital growth. And what that means is you can draw down some of your capital in the form of income to pay your day-to-day expenses, meaning when times are tough, you don't have to dip into your pool of capital, and you can double your capital every 10 to 12 years. And when I stop working and I wish to invest, that's exactly the sort of return that I'll be looking for, and this is exactly the sort of strategy that I would invest in. You can see that that portfolio, 5.2% free cash flow yield, funding a 2.7% dividend yield, is supported by a very high quality portfolio, as demonstrated by the quality metrics on the right-hand side relative to the broader market. We've grown the income consistently each year, and we expect to continue to do that. This year, relative to last year, it dipped a tiny bit, about 2%, because sterling was strong. It's a global portfolio, not within our control, but over the longer term, we expect to grow the income year in real terms. So that's, in terms of the strategy, what I was going to say. We face a world where valuations are quite full. Historically, markets are quite expensive, all markets, not just equity markets, and a world where disruption is identifiable. I think we can all see that technology is broadening and deepening in the economy, rendering many business models somewhat obsolete. We think, therefore, you need to be very clear about where you're investing to generate income. The inflation outlook is highly uncertain. The key point to this is we are not managing the portfolio based upon an inflation forecast, but we observe that high quality businesses, the same attributes that allow them to generate high returns on capital, also allow them to price and therefore be resistant to inflation. All of this put together means we think that this is the right strategy for the right time. I know I would say that, but we want to be seen as the quality, low volatility global income fund. Just a very quick word on the closed-end strategy, the Securities Trust of Scotland. This is run bang in line with our open-ended strategy. It has a discount control mechanism, which means that we issue stock at a slight premium, buy it back at a slight discount, which gives investors confidence that they can buy. The share price was traded close to the NAV, which so you can buy and sell, importantly, close to NAV and not suffer a big discount drop in more difficult times. It also means the trust is more liquid than otherwise it would be, and that we can grow it. There are certain attributes relating to a closed-end strategy, relative to an open strategy. Ryan mentioned those, And for some investors, that can make it more attractive. So thank you very much indeed for your time this evening. I hope that's given you, quick although it has been, a good idea of what we're trying to achieve here, the sorts of investors that we are trying to provide a solution for, and maybe some food for thought for your ISA for this year. So thank you very much indeed.